you all for coming tonight. Fighting traffic and things of that sort. It's been a great event so far. I think just with everybody having nice conversations and getting together and just sharing stories about investment in real estate has really charged me up, and something I'm very passionate about. Larry's words were wonderful. Hope Communities is, like Larry said, a nonprofit here in Denver. They do wonderful work in the community, provide affordable housing for the working poor, basically, is the way that it's kind of captured. And Larry and I have had a very good relationship here over the last year, and look forward to continuing working with Hope. So if there's any way you can support them, know about them, they're a wonderful organization. And kicking off with my real estate seminar, basically what we're going to be talking about is three main items. Strategies that investors take. Some of you may have been in several of these different strategic areas and go through that as an investor. The benefits of real estate, some of which will be really obvious and we've all heard of, and then some others I think are very good to remind ourselves about. And then a sample analysis, which a lot of my clients, through me creating brochures or an opinion of value when I list their property, they may have owned an apartment building or commercial property for 20 years and still asking, how do you get to what a cap rate is, or how do you calculate this type of rate of return? And so I'll make no bones about it. I'm going to keep some of this stuff remedial and fun, and there will be time for questions. Definitely, we're going to have a question and answer portion at the end of the entire event after my presentation and Kennan's presentation, but we will also, I'll have probably a few questions right after my presentation. So if you have something, just write it down. I wanted to introduce the esteemed panel of folks that are going to be helping me out today. We've got in the corner here Dennis Hogan, is my personal CPA, does a lot of real estate taxes, and we'll be able to answer real specific. Make sure you give him really difficult questions that I'm sure his mind's not fried at all in February, right before we get to April. But Dennis is here from a tax perspective. We've got Darren and Scott from SAIS, and Darren and Scott help people with basically personal investments. They're here to discuss several items, and basically we can do that in the question and answer portion. But one of the popular things about real estate that we've been seeing is people that are able to borrow from either their 401k or IRA and invest that into real estate, be able to take that from kind of an intangible, uncontrollable type of investment to something that they can put their hands into and control. So Scott and Darren are going to help out a lot with that. And then, of course, we've got Kenan Cohen, who's in the back. You'll see his presentation after mine. Kenan works with asset preservation, and asset preservation is a wholly owned subsidiary of Stewart Title. In several of my clients here, I've worked with Kenan on 1031 exchanges. They're phenomenal. They've got a great insurance policy. They're very reputable. Have not had any issues that I know of with important things like a tax-deferred exchange where they're holding on to a lot of money for people and are a trusted advisor. So we'll go through these several items here today, and it's going to be a lot of fun, so enjoy yourselves. We're going to have some drawings, so be prepared. There's going to be a bunch of different ways that you can win some goodies, so that'll be fun too. And if I can figure out how to work the clicker, we'll actually get into the presentation. Investment strategies. Most of my clients handle real estate in long-term rental, basically a cash flow model. There are two others, and I've categorized them as item 2A and 2B. I won't really talk much about them. They're actually very well publicized when you're watching HGTV or any of the reality shows that are out there. Flipping and renovating. Flipping is the process of purchasing a property, maybe putting some cosmetic or even extensive renovations into it and then selling it very quickly. And then renovations, you can do that in several different ways. Developers will take a property all the way down to the studs, replace all the wiring, plumbing, etc., and do an extensive remodel. And they may hold it for investment purposes or actually sell it afterwards. So it's kind of a combo, which is why I've got it as 2A and 2B. And it's important just to mention that my focus daily is helping people purchase apartment buildings, commercial properties as good long-term investments that will help them further their retirement. And that's really a lot of fun for me, is helping people realize their goals and their dreams. There's 6 basic real estate investment benefits that I'll discuss. Passive income and cash flow, which I think is one of the things that, when I'm speaking with people on the phone, is most important thing that people look for, because a lot of other real estate investments may be short of capitalizing on your dividends or things of that sort. It's really difficult to have an investment until you sell it to actually reap some sort of reward, and real estate allows for that. You have monthly cash flow coming in that's above and beyond your expenses if you're doing it right, and that's a huge advantage of real estate. Retirement planning, tax advantages, I'll touch briefly on those, but Kenan and Dennis will have a much larger part of the conversation. Diversification, something that I think all of us are thinking about. How do we spread risk across our portfolio? Financing, which is also called leverage, and inflation, hedge on inflation. This isn't just all about benefits. Obviously, real estate has some cons of which we know about. It requires management. This is not something that's passive completely. It is going to take a little bit of time and energy to manage your rental property, and it does require some oversight. It's not a full-time job. I guess it can be depending on the day. Some of my clients are probably saying, I don't know what you're talking about. It is a full-time job. But another con would be it's not as liquid as the stock market or some of the other exchanges. You've got a situation where you own a tangible asset that has to be sold, and that sales cycle can take anywhere from a few months to, depending on the property, years. It just depends on the type of real estate you're owning. Passive income, again, steady stream of residual income. The goal here, and we'll actually go through a detailed investment analysis that shows how you generate income month by month by owning investment real estate. Retirement planning. I want to share a very quick story about a client of mine that he's more of a mentor than a client. I've never actually helped him purchase real estate, but he was a real estate broker for over 30 years. About 15 years into his career, came into some inheritance, had an in-law pass away, and he and his wife purchased 2 apartment buildings over 2 years. From those apartment buildings, they generate annually about $100,000 of cash flow. They're retired. They have stocks and they have other types of investments, but that basically is creating like having a full-time job income, or something that's very, very passive for them. They have the ability to have management. They can go on vacations, and that really is something that I think is phenomenal for people. And he really did not start that process until his mid-40s. So it's not something that you need to start when you're very young. You can do it at any point. I think retirement planning is one of those things we're always trying to figure out. How are we going to fund this lifestyle that we're all thinking about when we're enjoying our days on the beach, and how's that all going to work for us? Tax advantages, there's 2 main tax advantages I'll discuss, and then there's the tax-deferred exchange, which Ken will go through in detail, so I'll actually not speak much about that. As an investor, you can deduct the interest that you pay on your mortgage annually, which is, you deduct that like any other operating expense, which I think is very unique. If you think about it this way, when you obtain a loan on a property, that's the acquisition process. It's not really an operating expense. But what's actually happening, though, is your tenants and the other income streams you have on that property from laundry or vending are basically subsidizing the way that you purchase your property. And if you're doing it right, you have the ability to make more than what your mortgage payment is in cash flow and reap that benefit. You're obviously taking risk to do that, but I think that's one of the wonderful tax advantages the IRS allows us to do. It's very legal, it's very straightforward, and it's one of the best parts about real estate. The depreciation part is something that I find very interesting. I'm not an accountant, so I don't know if I'll explain this the best way, and Dennis may be able to comment on it as well, but depreciation basically to me is a paper loss. You're not actually experiencing any type of cash outlay. You have the ability with residential property for it's 27 and a half years that you're able to take straight line depreciation, and what that does is you're able to basically take a deduction on your tax return every year from basically the idea that your property is losing value from the IRS perspective. Now this is in a way a loan from the IRS. You do have to pay back a portion of that 25% upon a sale unless you do a tax deferred exchange. But that's one of the best ways. It basically offsets a lot of your income and really a large advantage for real estate investors. Diversification, I think this is a subject that a lot of us know and understand, but it's just important to mention that any type of investing that you do, you want to make sure that you're spreading risk across several different assets. And I think the majority of the public looks at investing in intangible assets, assets that are really difficult for me. I mean, I can own Apple stock and go buy an iPhone and feel good about it, that I'm somehow making things better for myself, but the reality is that's not really going to move the needle all that much. And what you can have happen is if you buy a duplex, fourplex, 10-unit property, whatever the amount of units that you own, you can go over there, you can maintain it yourself or hire someone to do that. You can check in on the tenants, some of which you may like, some of which you may not like from time to time. But the whole point is you can actually affect the investment as opposed to just kind of putting your money out there and just hoping that it's going to work. And the things that I've seen with real estate is it may not be as, it's certainly a little bit more stable when it comes to owning investment real estate and the returns you'll receive there. So it may not have the wild returns you sometimes experience in the stock market, but at the same time you don't have some of the wild losses and the roller coaster that I hear a lot of my clients expressing. Again with the slides. Financing and leverage. This is something that I find is very different to real estate. Most investments you have to purchase 100% with cash. You really don't get the benefit of being able to borrow and increase the ability to invest. And in real estate, you can go to a bank. There's also ways that you can use your own retirement funds. Now, this is a loan that you would actually take from your IRA or 401k and invest in real estate, and absolutely be able to capitalize on what you've already been saving for in your company's pension plan or 401k. A big disclaimer that I want to share is that I am a big proponent of conservative investing. This is not a get-rich scheme. Scott had mentioned this to me. It's actually, real estate is very much a get-rich-slow type of business. But at the same time, what I'm basically proposing is that the majority of my clients, when they purchase real estate, are doing that with 25 to 35% down payment. And what that does is it enables you to weather the storm. It enables you to experience vacancy, unit turnovers, things of that sort, and not have to worry about basically being underwater with your mortgage. And so very different from a no money down type of very quick and easy type of real estate investment. This is something that really doesn't get reported a whole lot, but I think in investment real estate, when you're talking about apartment buildings and other commercial properties, it is something that I think the majority of the investors get out there and really make sure that they're being conservative about the debt that they're using. It's also a good hedge on inflation. Generally, most people look at inflation as something that just, again, a general definition is that the cost of goods and services 5, 10, 15 years from now are probably going to be more than they are today. And we've experienced this in historical averages, and it can be somewhere between 3 and 4% or higher or lower depending on the economy. The thing I like about real estate is that you have the ability to hedge against inflation both with your rental. You have the ability basically to have those rents rising at the time that inflation is rising as well. And then also when you eventually sell the property, that asset, assuming that things have gone correctly, will also have appreciated along and hopefully above what depreciation is. The big effect with excuse me, I said depreciation, I meant to say inflation. The big effect with inflation, I think, is on retirees, folks that may not have a day-to-day job with W-2 income. They're in fixed income type of assets, Social Security, annuities, things of that sort. Really a struggle with those type of assets of being able to beat inflation over the long term. And real estate, it really helps that. So we'll go through my investment analysis. I'm going to mention that this will probably be the portion that most of the questions will come from. If you wouldn't mind just holding them to the end of my presentation, I'll answer as many as I can, and then we can, of course, ask questions at the end of the presentation, too. This is an apartment building I just sold in December. It's at 1328 Corona Street in Capitol Hill. A nice 10-unit apartment building. Story to share with the group here about my clients that purchased it. They bought it in 2006 for $625,000. It just sold for $875,000. So not only did they have the ability to really capitalize on the monthly cash flow that they received, they also ended up buying the building in hindsight in a wonderful market for purchasing. It was very difficult to obtain loans at that time. To Larry's point, one of the reasons why we were able to get that deal done is I had to call like 10 different lenders just to be able to source that loan. But we ended up getting the deal done, and they sold it 3 years later for a very nice profit. 10-unit apartment building right in the middle of Capitol Hill, and has 8 parking spaces in the back. Obviously, as you can see, it's a cute little building, and this is a lot of what I do on a day-to-day basis. I help people with the purchase and sale of apartment buildings that look just like this. So here's the analysis. Basically, the way you look at it is from a year standpoint. You've got a certain amount of rental income coming in. I changed the numbers slightly. I didn't do the broker thing and change them wildly to make sure that this was some pretty picture, but to protect the innocent, I did change the numbers just to keep them round. The rental income, we'll say, is $90,000 a year. There are operating expenses that pretty much every owner can expect. There's different operating expenses depending on the areas that you're located in, but insurance, management, taxes, utilities, repairs, and administrative expenses are pretty much what most people can expect. So we've got income of $90,000, and those total $28,500. So the common term that this is called when you're taking your income and subtracting it from your expenses is net operating income. So the quick math there is 90 minus 28.5, you get $61,500. If you own this building free and clear, that's what your annual return would be. You'd have $61,000 every single year of income. Depending on how things go over the following years, that may fluctuate, of course. But to me, this is a powerful statement. Again, the whole get-rich-slow type of concept. You have the ability to basically, there's a lot of people in the U.S. that don't make more than $60,000 a year. You have the ability to do that fairly passively. And if you'll notice here, there's management costs associated. So really, in this example, they were able to do it without a whole lot of effort, besides just kind of monthly tasks and things of that sort.